Hello! In this presentation, we will be talking about the advantages and disadvantages of the different forms of business organization. Particularly, we will be covering sole proprietorship, partnership, corporation, S-corporation, limited liability company, and limited liability partnership.
Sole proprietorship, an incorporated business owned by one individual in which the owner has full control of the operations. It is used primarily on small businesses. And in the Philippine setting, a proprietorship is required to be registered in Department of Trade and Industry, in Bureau of Internal Revenue, and other local businesses permits. The advantages of sole proprietorship are easily and inexpensively formed, subject to few government regulations since it's for small businesses, subject to lower income taxes than our corporations because the proprietor and the business are considered one taxpayer and shares the same taxpayer identification number or the TIN. And the disadvantages of sole proprietorship are proprietors have an unlimited personal liability, limited life of business, and difficult in obtaining large sums of capital. Partnership is a legal arrangement between two or more people who decides to do business together. Partnerships are either general or limited. In a general partnership, the partners have an unlimited liability for the obligations or debts of their partners, while in a limited partnership, the partner's liability is only up to the value of their capital contribution. Partnerships are registered with the SEC or the Securities and Exchange Commission if its capital is more than 3,000. BIR registration and local business permits are also required. The advantages of partnership are it can be established relatively easy and inexpensive, ease of raising capital as compared to sole proprietorship, and also if there is more than one general partner, it is possible for multiple people with diverse skill sets to run a business, which can enhance its overall performance. In general, it means that there is more expertise within the business. Unlimited personal liability is the major drawback of general partnership, in which partners are personally liable for all the obligations of the partnership. This means that if the partnership declares bankruptcy, the unpaid creditors can run after the personal assets of the partners.
A corporation is an artificial being organized under state laws whose investors purchase shares of stocks as evidence of ownership in it. In order for a corporation to exist, the Revised Corporation Code or the Republic Act 11232, which was signed on February 20, 2019, is governed. Before, the Batas Pambansa Bilang 68 or the Corporation Code of the Philippines states that a corporation is given a maximum of 50 years. And after that year, the corporation needs to renew it. But because of the Revised Corporation Code or the RA 11232, there is a removal of maximum 50 years of corporate term, which means that a corporation shall now have a perpetual existence unless their articles of incorporation provides otherwise. The advantages of a corporation: limited liability. So the shareholders of a corporation are only liable to the amount of their investments. Going beyond that, the investors or the shareholders are protected. The ownership transfers, wherein the shareholders can sell shares in a corporation, but it is restricted in a privately held corporation. Next, the perpetual life, where there is no limit to the life of a corporation since the ownership of it can pass through many generations of investors. And lastly, the pass-through. The disadvantages of the corporation as follows. Number 1, double taxation. What does this double taxation mean? So, the corporation needs to pay the taxes as well as the shareholders needs to pay its taxes upon receiving its dividends. Other one is the excessive tax filings, wherein there is a required substantial amount of paperwork that a corporation must submit to the government in filing taxation. And lastly, the independent management, wherein the management team of a corporation can operate the business without any oversight from the owners.
S corporation, or also known as S subchapter, refers to a type of corporation that meets specific Internal Revenue Code requirements. The requirements give a corporation with 100 or less shareholders the benefit of incorporation while being taxed as partnership. The corporation may pass income directly to shareholders and avoid double taxation. The advantages of S corporation include limited liability for management and shareholders, unlimited number of management, distinct court-recognized existence, which helps you protect from personal liability that can cause you to lose your personal wealth in assets like your home or your car. Flow-through taxation, great potential for income splitting of owner or employees. S corporations are great for businesses that will provide a service, that will not have significant startup costs, that will not need to make major equipment purchases before beginning operations, and will make a sizable amount of money without great deal of effort and expense. The following are the disadvantages of S corporation. At shareholder level, the shares are subject to seizure and sale in court proceedings. There should only be a maximum of 100 shareholders. The owner or employees holding 2% or more of the company's shares cannot receive tax-free benefits. Because flow-through taxes will be paid at a personal rate, high-income shareholders will pay more taxes on their distributions. If tax status is compromised by either non-resident stockholder or stock being placed in corporate entity name, the IRS will revoke status, charge back taxes for 3 years, and impose a further 5-year waiting period to regain tax status. It is not suitable to hold appreciating investment. Capital gain on sale of assets will incur higher taxes than with other pass-through entities such as LLCs and limited partnerships. Lastly, it is only limited to one class of stock.
Limited Liability Company or LLC. It is a business structure that is hybrid between partnership and corporation. Additionally, owners are not personally liable for the company's debts or liabilities. Banks and insurance companies cannot form an LLC, only the individuals and corporations. These are the advantages of limited liability company. It passed through taxation, no restriction on the number of members allowed. Members have flexibility in structuring the company management, does not require as much annual paperwork or have as many formalities as corporations. Owners are not personally responsible for business debts and liabilities. And lastly, it provides more flexibility and protection. These are the disadvantages of limited liability company. It is more expensive to form than sole proprietorships and general partnership. Ownership is typically harder to transfer than with a corporation. It has limited life. And lastly, depending on state law, an LLC may have to be dissolved upon the death or bankruptcy of a member. Limited Liability Partnership or LLP. It is a type of business structure that gives protection for individual partners against the negligence of other partners within the organization. It is similar to an LLC but used for professional firms in the fields of accounting, law, and architecture. It provides personal asset protection from business debt and liabilities, but is taxed as partnership. These are the advantages of limited liability partnership. First is liability protection. It protects the individual partners against personal liability of other partners. In addition, individual partners are not personally responsible for partnership debts or other obligations. This is advantageous for an individual partner when potential lawsuits or claims of negligence against the business are concerned. Second is tax advantages. The company's credits and deductions are distributed to file individual tax returns. This can be beneficial for partners who have a limited interest in the company or special tax requirements due to their interest in other businesses. And lastly, we have flexibility. Partners have the right to decide how they can contribute to business operations individually. Additionally, partners who have a financial interest in the company can elect to not have any authority over business decisions but still maintain ownership rights based on their percentage interest in the company. These are the disadvantages of limited liability partnership. First, we have special tax considerations. Because of its tax complexities, some states prohibit LLPs. In addition, it is also considered as a non-partnership for tax purposes because of its special structure and extremely complex tax filing requirements. Second is it is not recognized in every state. Some states limit the creation of LLP to professionals and doctors or lawyers. Other states also allow but will impose heavy tax limits on the entity, both when formed and ongoing. That's why many parties perceive LLPs to have less credibility as true business than corporations. Lastly, we have one partner can bind others. In making business agreements, the individual partners are not obligated to consult first with other participants. It is a disadvantage because they can make decisions based on personal interest and not in the interest of the partnership as a whole.